Well, you can buy, say, a stock like Ashok Leyland, which is now around 250. If it crosses 253, then it can go up to something like 266. And if you are planning for good investment bet, I would say there is one stock in the banking space that you can buy is IDFC First Bank. Vaidyanathan said that from the third quarter, things would really move up, and it has come to its major support area, which is just below 70. So your risk is much less, and it's a slow mover, but you will get good opportunities.
Rahul, just wanted to know if you have a view on autos. They were seeing a lot of seesawing over the last few sessions.
Yeah, we do. I think, there has been a reasonable pullback in terms of valuations. We've seen intraday pullbacks in Tata Motors, M&M, Maruti at various points over the last 1 month or so. So I think on the passenger vehicle side, we still continue to like Maruti. I think we're still looking at about a 13-14% compounded growth over the next 2 years. I think ever since Mahindra spoke about, their focus on return on capital employed, the stock's been a multi-bagger. But I think given the way we are looking at the monsoon spanning out, I think this would still continue to be a good year for tractors as well as for commercial vehicles. So I think Mahindra and Ashok Leyland respectively could be played there. And I think if you're playing two-wheelers, and I'm not including the EVs in this because there's been a lot of talk about EVs in the past, but I think Hero is not a bad bet. You're also getting it at about a 3% dividend yield or thereabouts. So I think in different sub-pockets of auto, I think these would be some of the ideas that we would recommend. And I think if you're playing it through auto ancillaries, we do like names like Sansera Engineering. We have a proxy to say a lead in like a Jamna Auto in the past. So we are not going in and aggressively buying. I think most of these stocks that I have told you would have anywhere between a 10 to 20% upside. But we are selectively definitely looking at ideas in the auto sector.
Okay. Rahul, Rajat, we'll leave it at that. Thanks so much for taking the time out and being with us. So really appreciate your time this morning.
Thank you, Neeraj.
By the way, must mark Nifty IT is the best performing index, 1.7% higher, and it's not one particular stock which might be taking it higher, it's across the board. If you look at the Nifty IT gainers and losers, no losers per se, but Tech Mahindra, HCL Tech, Wipro, Infi, all of them around 2% higher. So it's a broad-based move that's happening in Nifty IT. The other aspect to focus on is Airtel, and what is it that brokerages have made of those results, because the stock is up about 1% and knocking on the doors of 1500 yet again. Rucha Johnson with what the brokerage view is. Rucha, good morning.
Good morning, Neeraj. So before brokerages, I'll just give highlights of the results. Positive on India operations. Revenue was up about 2%. Net profit was up 7%, whereas wireless revenue was up about 2%. The other highlight is that ARPU was flat, around like 2 rupees up, around 211 versus 209 in the previous quarter. Now coming to brokerages, Citi is the most bullish one with around 19% of upside and a target price of 1750. Now it said that India CapEx shows sign of moderation according to the management commentary in the past quarter, and this is what drove the free cash flow higher along with deleveraging. Now this is when the brokerage house expects that shareholders could get dividend and buybacks from Airtel. Also talking about JP Morgan has a moderate upside of around 2%, but it was surprised positively on the India capex stability and acceleration in the free cash flow. Now revenue growth was strong in the homes segment, and Bharti Airtel also announced deferring of calling the partly paid up shares due to strong free cash flow and generated by lower capex and deleveraging. Now according to CLSA is also bullish on Bharti Airtel with upside of about 5%. The consolidated numbers were largely dragged because of African business, because of deleveraging, because of devaluation of the currency. Board also feels that there is no immediate funding requirement, is what CLSA has to say on the stock.
Okay, Rucha, thanks so much for that. 1% higher for Airtel as we speak. Keep an eye out for that stock too. What we do is take a quick break. Up next, some market conversations and some corporate conversations. Start off with Mr. Jayesh Gujral, MD of Syrma SGS.
the whole day passes like a blur. The news just whizzes past, and you're trying to stay informed. It is our job to bring you news that truly matters. At Profit 360, we cut through the clutter, the long street deals, finance and policy news that could shape your tomorrow. The newsmakers, the trendsetters, and the innovators. In 30 minutes, we've got you covered. So stay ahead, stay informed, and stay profitable with Profit 360.
Headlines you start your day with. What matters worldwide is now in the palm of your hands. Get ready to seize the day and maximize your financial potential. Stay ahead of the curve with all you need to know on NDTV Profit.
Listen to the voices of reason as they talk about corporate health and investing principles with me, Neeraj Shah, on my show, Talking Point.
Let's be real, guys.
Good morning and welcome to Earnings Edge right here on NDTV Profit. We're now in conversation with Syrma on the back of the Q1 earnings, which saw strong revenue growth of roughly about 93%, but on profitability there was a slight impact and degrowth. To talk more about the Q1 numbers as well as a deep dive into the verticals that the company operates in, we're now joined by Mr. Gujral, the Managing Director of the company. Mr. Gujral, thank you so much for joining us today and a very good morning to you. Just to start off with, the Q1 numbers specifically, we've seen a very strong revenue growth across verticals like consumer, IT, as well as healthcare. But margins have been down in this particular quarter by about 440 basis points, coming in around the 5% range. Just if you could just talk us through, what has led to this margin fall. Is this an increased penetration of the consumer growth sector and just on these verticals as well, sir?
See, the business this quarter has been good. We have grown by 92% odd in the total revenue of the company. And as I had said in my earlier calls, that the business mix is seasonal. So in the first quarter, we saw a high proportionate growth of consumer business, which stood at about 54%. Now, this 54% consumer business led to a contraction in the material margin. We had a 4% saving in the operating overheads, and hence the EBITDA margin contracted by about 2%. So we're very confident that going forward, the annualized earnings which we had guided and the EBITDA margin, the plans remain intact. The high margin business would kick off in the coming quarters. First quarter was comparatively slow on exports also. Exports were only 16% of our revenue, against a targeted figure of 20 plus. So going forward in the remaining 3 quarters, we believe and we are confident that the business would come back to normal with the revenue growth of what we had guided, and EBITDA of about 315 crores is in line of achievement.
Just wanted to get into the verticals that you operate in. You didn't mention about the consumer sector, but another strong growth engine is of course the IT as well as the railway space. I just wanted to talk us through these particular 2 verticals. Within these, what segments are you targeting for both IT as well as railway going forward?
See, IT growth is still nascent. We have the IT PLI, but we are in the process of tying up with some customers. There's nothing concrete as of date. So I would not be able to put a figure on the IT business. On the railways business, we have orders. And as I had guided earlier, this year we should expect railways to be anything between 60 to 70 crores of revenue in this year. The verticals which we operate upon are automotive, industrial, healthcare, railways, and consumer. So all the verticals are seeing a growth, and we have tied up with some good brands in the industrial sector, which would see turnovers coming in the second to third quarter of this financial year.
Just if I could, come back on the IT part, you said that you are still tying up with customers and looking to, increase that particular business. But you already are applicable. So this is the IT hardware PLI, if I'm not wrong. And what kind of PLI benefit did you have in the last year, and are you expecting the same in this particular year as well?
See, IT PLI, we got the application approved in November of last year, November of 23. So there was no IT PLI benefit factored in the books because we got the approval pretty late. In the current year, we are tying up with vendors where we can leverage the application of IT PLI which we have got. But currently there is nothing concrete on the table, and hence I really can't put a figure to it that what will be the IT revenue because of the PLI application. We do our IT revenue of about 70-80 crores. That will continue in the normal course of the business. But how much leverage we can get out of the IT PLI application, I really can't say a figure today till I tie up with a customer.
Understood, sir. And anything on railways, are you also currently doing orders for the Kavach? Because we are expecting some orders and a big push over the next couple of years. We've seen some commentary in the budget as well. Are you already tied up with some customers for this or are having conversations? And if not Kavach, what other verticals do you operate within railways?
See, in railways, we have tied up with a Japanese ODM supplier, which is doing the Kavach and the other safety signaling equipments. So we are at tier 2. We have an ODM Japanese partner for which we will be making and then supplying it to the railways.
Now, just wanted to talk about, the healthcare division as well. We've seen an increased focus for the company in this particular vertical. And you made an acquisition also of a company called JDHL last year. And, you did inform that you have a research design center coming up in Pune as well. If you could just talk us through what has been the focus and what could we expect from this vertical? You're also focusing on a lot in ODM in the medical space as well. But within the EMS segment, we've seen medical equipment being very subdued for most players. So how, for Syrma specifically, if you could talk us through this vertical and what kind of expectations do you have for this year?
See, for the healthcare business, including medtech devices, our plans are intact and we expect to do a significant revenue of about 350 plus crores, which would be both EMS and the products. The design center which we have set up in Pune will be commissioned later part of this month. And we already have got some good leads into the ODM designing contracts. I'm not at liberty to name the customer, but we have got a good $2 million contract on designing for a medical device. The revenues of which, this is a designing income which I am referring to, but the product income would flow it in the coming years, 25, 26, 26, 27. On a whole, the medtech business looks to be on a sound footing. And as I just guided that we should be ending up the year with about 350 crores of healthcare business.
Well, Mr. Gujral, thank you so much for joining us today right here at NDTV Profit and speaking to us in a very detailed conversation for Q1. We wish you the best and commiserations for being reappointed for the next 5 years. So look forward to our next conversation as well. But thank you so much for joining us today.
Thank you very much. Thank you.
Well, that's all the time we have on this edition of Earnings Edge. Stay tuned to NDTV Profit for more.
When the whole day passes like a blur, the news just whizzes past, and you're trying to stay informed. It is our job to bring you news that truly matters. At Profit 360, we cut through the clutter, the Lord Street deals, finance and policy news that could shape your tomorrow. The newsmakers, the trendsetters, and the innovators. In 30 minutes, we've got you covered. So stay ahead, stay informed, and stay profitable with Profit 360.
Headlines you start your day with. What matters worldwide is now in the palm of your hands. Get ready to seize the day and maximize your financial potential. Stay ahead of the curve with all you need to know on NDTV Profit.
Let's be real, guys. There are many financial experts out there. Which stocks to target? What's good for long term? When to buy? When to sell? How do you stay ahead of all the financial noise to achieve your dreams?
You can accomplish all your financial dreams. Let us worry about giving you the right investing insights on the Portfolio Manager.
Motherson Sumi Wiring India Limited has reported a stellar set of numbers in the first quarter of the fiscal, with the bottom line jumping by about 21% and the revenue is up by about 16.7%. To talk to us more about the numbers are the company's CFO Mahinder Chabra and CEO Anurag Gehlot. Gentlemen, welcome to NDTV Profit.
Thank you very much.
My first question is to you, Mr. Gehlot. In the press statement accompanying the earnings, you mentioned about some automotive mega trends that are working in your favor. Can you tell us what are those mega trends, so to speak, and how are they impacting your earnings?
Okay. If you see that market has, passenger vehicle particularly market has grown by 6% and our revenue has grown by around 17%. And this growth is majorly because of two reasons. One is obviously the volumes are growing up, that's fine. And the other one is that the customers are choosing now the feature-rich model vehicle. So the upgrade is happening. So once the upgrade happens, then the content of wiring harness goes high. And as you choose the top model, content goes high. So our sales directly get impacted because of that. So if you see that SUV is still growing into the market, and that is one of the main reasons that how MSWIL is getting benefited out of.
Okay, so aren't you seeing any impact of the inventory buildup that is actually being seen in the industry in the last 3 months or so?
We have to see it, the past of how the vehicles are selling or how the market remains. I think traditionally Q1 remains a little weaker side if you see in the past. And then as you know that, all the customers are heavily investing into the capacities. So it's just a matter of time, or we can say, some weeks here or there. And I think market looks positive to us.
To add to that answer, there's also a case of price rationalization that we are seeing from OEMs. They're launching new models with certain features. They're reducing the prices of a top-end model. How does that impact you? They say that it's reducing the impact on the supply chain. What is your take on that, sir?
This is better. This question is better to ask to the OEMs only, but I can only say that we are very much aligned with to the customer volumes that they are gearing up. And there is no as such impact on us directly because of giving their offering to the market.
Mr. Chabra, coming to you, we see that your EBITDA is up about 15%, but there's a marginal decline in the margins. That's about 18 basis points decline year on year. Mr. Chabra, can you talk to us more about it? What's the dynamics there?
Yeah, so if you look at profitability for the quarter, so first of all, we measure our performance in terms of profitability on ROAS, return on capital employed, and there we have a guidance of 40%. And we are well on track to deliver beyond 40% for this quarter as well. However, if you look at the P&L, like we also have 2 plants which are coming up. So there are certain ramp-up costs which have been there in this quarter in the P&L. So to that extent, the EBITDA is getting impacted because of that. But yes, as a profitability, we look at ROAS as our measurement, and we are well on track to deliver more than 40%.
So the margin impact is mainly due to the new plant that has gone on stream in July?
That's right, yes.
All right. You also intend to increase the utilization at this particular plant. Can we expect much more impact on the margin going ahead in the rest of the fiscal? Mr. Chabra.
Yeah, okay. So as far as margins are concerned, yes, the new plant that has been put up, the one plant will start operations in July. It's already started the operations, and we'll be getting the customer orders as per their forecast. So we should also have the revenue getting generated from one of the plants.
Okay. Coming back to you, Mr. Gehlot, most car makers are in expansion mode. They want to increase the capacity substantially between now and the end of the decade in 2030. Electrification is coming in, premiumization is coming in. So where do you target, where do you fit in, and what are your targets accordingly?
See, if customers are increasing their capacities, we are very much aligned to that. And that's the reason you have seen these 2 new plants which are coming up. And there are furthermore plants which will be coming up. So we are very much aligned to these customer requirements. Obviously, this is a spread of next 6 to 7 years when these what targets or what volumes they are predicting that they are to achieve. And we are also budgeting ourselves, and we are aligning them ourselves according to these increasing capacities in the different locations. So as on today, we are 28 plants, and they are very near to the customer vicinity. Obviously, that gives a lot of confidence to the customer also. And communication remains very good. So our all plans are wherever the customers are going, we are just following them.
All right, because you actually preempted my next question is that are there any plans for new plants, so to speak, near where the centers are coming in? So any more new plants?
Yeah, definitely. You will hear from us maybe later in the year.
Okay.
Because we are, as I said, we are aligning with the customer requirements, and we just follow the customer. So if customer is going in any part of the country, we just try to be very near to them.
Okay. Coming back to you, Mr. Chabra, you say the EV revenue grew by about 50% year on year in the first quarter FY25. What is the percentage of the EV business in the overall revenue at this point of time, Mr. Chabra?
Yeah, so if you look at the current quarter, the EV contribution will be close to 4% of the overall revenues.
Okay. So will it keep on increasing here on? Because we have seen certain slowdown in terms of adoption, so to speak. The numbers are not increasing substantially. So is there a target that you have set that how much revenue should come from the EV business, Mr. Chabra?
So I would say it would be in line with the demand of EVs in the market. I mean, depending on the demand, we would be supplying the wiring harness to EV manufacturers. So it largely depends on the demand in the market for EVs.
When the whole day passes like a blur, the news just whizzes past, and you're trying to stay informed. It is our job to bring you news that truly matters. At Profit 360, we cut through the clutter. The Log Street deals, finance and policy news that could shape your tomorrow. The newsmakers, the trendsetters, and the innovators. In 30 minutes, we've got you covered. So stay ahead, stay informed, and stay profitable with Profit 360.
Headlines you start your day with. What matters worldwide is now in the palm of your hands. Get ready to seize the day and maximize your financial potential. Stay ahead of the curve with all you need to know on NDTV Profit.
Listen to the voices of reason as they talk about corporate health and investing principles with me, Neeraj Shah, on my show, Talking Point.
Let's be real, guys. There are many financial experts out there. Which stocks to target? What's good for long term? When to buy? When to sell? How do you stay ahead of all the financial noise to achieve your dreams?
You can accomplish all your financial dreams. Let us worry about giving you the right investing insights on the Portfolio Manager.
When the whole day
Good morning and welcome to NDTV Profit. This is Talking Point. I'm Muralidhar Swaminathan. My colleague Neeraj Shah will join in a while. He's had a long morning and he's taking a short break. He'll come back. But the other Mr. Shah, Nilesh Shah, MD of Kotak Mahindra AMC. He's an expert on markets, manages one of the largest mutual funds. We don't need any special introduction. He's also busy and we can see him. He's stuck in a car in a traffic. Nilesh, good morning and welcome to NDTV Profit.
Thank you, Murli. My pleasure being here.
Okay, so I will start with the first question. What is the root cause of the current sell-off? Before we go on to other questions, what is your assessment? What do you think has triggered this big sell-off?
Murli, the simple answer is that sellers are more aggressive than buyers. Why have suddenly sellers become aggressive? One, partly it could be profit booking. Our markets have delivered tons of return to investors. And in a risk-off market, people don't mind booking some profit. Second, there are concerns emerging globally. Some people say it is yen carry trade reversal. Some people say it is geopolitical risk in Bangladesh, Israel, Iran, and so on and so forth. My feeling is that it's a combination of everything, which is pushing sellers to sell aggressively and buyers to bid conservatively. That mismatch is resulting into market correction.
Right. So how much weight will you put to this fear of US recession? Because, that was used, the jobs data was used by players in the US market on Friday to say that, look, recession fears are back and that's being seen as one of the reasons. How much weight will you put to US recessions?
So one, the whole market has been going wrong about US economy, including US Fed. From inflation is transitory, it will remain elevated for a longer time, to now looking to cut rates to support economy. has shown how difficult it is to predict US economy, even by the mighty Fed. Our knowledge on US economy is limited, and our linkage to US economy is also limited, bearing sectors like technology which get influenced significantly by US economy. Our domestic focused sectors have very limited linkage with US recession. So my feeling is that our markets have run up a lot. People don't mind doing some profit booking, and the cause could be US recession today, Fed cut tomorrow, yen carry reversal day after tomorrow, and geopolitical risk some other day.
So it could be any reason to book profit in an overvalued market. You really brought to light in your tweet last week about how a segment of the market is so overvalued that we are discounting some 50 years of earnings. Can you throw some more light on it? And meanwhile, I'll also welcome my colleague Neeraj. Neeraj is also joining me in this conversation. Go ahead, Nilesh.
So essentially, it was back of envelope calculation to show how market is far more forward-looking. There are about 359 stocks which have delivered more than 100% return since COVID low in BSE 500. There are more than 28 stocks today compared to 93 stocks in 2020 pre-COVID, which are trading at more than 50 years. That means they are discounting the earnings of company as much as in 2074. Third, we looked at returns from COVID days. The return for broad market was coming at 22%, whereas the 20-year return came at 14%. It meant that from 2004 to 2020, the returns were subdued. And then 2020 onwards, the return took off, which means that at today's valuation, one will have to moderate return expectation. So this was more of a back of the envelope calculation on BSE 500 to suggest how markets are far more forward-looking and extremely optimistic about future. Undoubtedly, if earnings growth continue their momentum, then these numbers will change. So limited point here, markets are optimistic. They are discounting future very, very positively.
Neeraj, would you like to step in?
Nilesh bhai, one question therefore. Does this make markets vulnerable to a large drawdown? Or do we all need to rethink how we're looking at markets simply because the nature and the power of the local investor in the last 4 or 5 years is very different from what it has probably ever been?
So Neeraj bhai, there are many people who say this is all due to domestic money. Undoubtedly, it is domestic money. But no one comes here to lose money. They all come here to make money. And in the markets, we have all kinds of people, some experienced, some not so experienced. My feeling is that overall people are positive on Indian economy. There is visible growth, there is good governance, and there is good corporate profitability. While despite market run-up and trading at all-time high level, our valuations are not at all-time high level, albeit it is trading at premium to other peers. So my feeling is that it's a combination of not just liquidity, it is also confidence about the future growth. And to all those people who are bearish on Indian market and believes this is a bubble, I have always asked one simple question. Are you willing to short Nifty at this level for next 10 years? So far, I haven't met anyone who is interested in taking my proposal.
Okay, but 10 years may be a long time. I'm just trying to understand because your post then would have made one think that is Nilesh Shah cautioning about the valuations, and could Mr. Nilesh Shah be bearish for a shorter term? I know you don't take tactical calls and you're a mutual fund guy, so you won't do this. But if you are not, would you believe there is a probability or a higher probability of a correction in the Indian markets currently? We've seen 4%. Can there be more?
So, Neeraj, it is always difficult to predict the market in the short term. In March 20, how many people would have predicted that Nifty will be trading at 25,000 or 24,000 in 2024? Hindsight, it is always easy to say, oh, this is yen carry trade reversal, this is geopolitics, this is US recession. But trust me, more people have lost money waiting for correction than actually in the correction. All we are saying is that one, market is optimistic about future for right reasons. Second, valuations in many cases are reasonably well ahead. And third, please moderate return expectation and invest with a longer term horizon.
Okay, so we will not go back to predicting where the indices would be, but this question will be about factors going forward. What are the factors that will move the markets? Now, this is fundamental because at one end of the globe, you have US which wants rate cuts, and that could be coming in a few months. And at the other end, you have Japan, which is hiking rates. It might put a little pause to hiking rates, but it is on that path. So you have a divergent global interest rate scenario that is emerging. How will markets react to this? Will there be a lot of shuffling around among different asset classes, like moving from equity to bonds, bonds to oil, and back and forth?
So, Murli, undoubtedly, asset allocators will try to sell what is expensive and buy what is cheaper. There will be undoubtedly those movement. Side mein khada. Now, if we look at India position, my feeling is that investors will look to buy into correction. Let's look at from a foreigner's point of view. The foreigners are today either equal weight India or marginal underweight India. There is a reasonably good chance that India's weightage in MSCI Emerging Market Index will go up. This will make many foreigners underinvested in India. Can they afford to remain underinvested in a growth market like India? Answer is undoubtedly no. So they will be using correction as an opportunity to invest. In every single IPO coming out of India, OFS coming out of India, we are seeing foreigners looking to buy and compete with mutual funds aggressively. Now let's look at domestic investors, insurance, mutual funds, pension funds. We all will be a buyer of India growth story. Let's look at retail and HNI. People who are expressing bearishness in the market are ultimately looking to buy at correction. So overall, my feeling is that corrections will be bought into. This time, investors have also become matured. This is real life Lagan movie being playing out. As you know, in Lagan movie, local team defeated foreigners. In COVID time, we saw One Day International being played out, where foreigners were selling for March, April, May, June, July 2020. They sold close to 70 to 80,000 crore cash equity. Retailers via mutual fund kept on buying. Then foreigners realized that Lagan mein jeetna mushkil hai. So they started playing test match. From October 21 to June 22, they sold 250,000 crore worth of equity. Retailers kept on buying slowly and steadily. Finally, foreigners realized that retailers are going to win test match also. So they gave up on test match format, came into T20 format. On the election result, they played like T20, sold about 21,000 crore in cash and about 8,000 crore in futures. Retailers bought that into. So my feeling is that there is a real life Lagan being played between domestic investors and global investors, and everyone will be looking to buy into correction. Now, someone may buy a 10% correction, someone may buy a 20% correction, but every correction will be bought into by local and global investors.
You know, in fact, yesterday you and your other colleagues in the industry must have bought what FI has sold. because FI sold 10,000 crores worth of shares and the domestic funds bought about the equal amount, 9,500 and odd crores.
Undoubtedly, mutual funds have asset allocation and balance advantage product, which can buy whenever market dips. The SIP flows have been very strong. And there is also new money coming in from retail and HNI investors whenever there is a correction. So there is a reasonable amount of depth in Indian market. Our fundamentals are good. Our governance standards are good. And we, provide one of the best opportunities on a price to earnings growth basis in emerging market. Now, gold doesn't come cheap. You have to pay the price of gold to buy gold, and which is where Indian markets are trading at premium valuation to others. But that doesn't mean that our markets cannot go down. Of course, they'll go up and down like any other market.
Okay. Nilesh bhai, the other question is a tale of two halves, if you will, or a barbell approach that Indian markets currently have, wherein people, there is enough opinion out there on what some of the, on the frenzy on some of the stocks, for example, in the defense space, in railways, in the EMS sector, etc., all of which probably form a part of those stocks which are above that 50, 70, 100 multiple, right? And the other end is the safety in valuations, but not the kind of growth that that the expensive names are showing. I would love to understand the current stage. Would you believe that there is merit in choosing safety in valuations over the kind of growth numbers that some of the expensive names are showing?
So Neeraj bhai, you hit the nail. Value is what you get and price is what you pay. This is the market where you focus on quality over momentum. This is the market where you focus on reasonable valuation over expensive valuation. This is the market where you focus on diversified ownership and market discovered prices, then low floating stock, concentrated holding, and market manipulated prices rather than market discovered prices. Now, in many stocks, holdings are concentrated in few hands because there is very, very low floating stock. This is resulting into valuations which are way ahead of their fundamentals and puts tremendous pressure on companies to deliver growth which is well beyond their capacity, in our opinion. Now, will this stocks correct today or tomorrow? I don't know. Will they correct when supply emerges, when minimum public shareholding norms are enforced, when some of the promoters of these companies realize that my shares have really run up and let me book some profit? Be the case as it may be, whenever supply emerges, these stocks are likely to fall quite sharply. And hence, focus on quality over momentum, high floating stock market discovered prices versus low floating stock and concentrated holding, and focus on reasonable valuation over expensive valuation. Do remember, price is what you pay and value is what you get.
Right. Now, if we have to focus on quality and liquidity and the stability part of what you're saying, what is the size of that basket of stocks? Is it 100, is it 200, or is it 300? Because anything beyond 200 or 300 looks quite vulnerable from all the factors and criteria that you have mentioned, Nilesh.
So today, if we look at large caps, maybe 70-80% of large caps falls in that bucket. If we look at small and mid cap, in mid cap, maybe the ratio is 50-50. Small cap ratio reverses to maybe 30-70. So there is opportunity in all basket, small, mid, and large. There are some stocks across private banks, technology, chemical, and consumer discretionary, where valuations are still reasonable, below or around their historical averages. Growth looks fine, and hence one can look to invest from a valuation point of view. it does not necessarily mean that they will start outperforming market from tomorrow onwards. Unless until supply emerges, it is unlikely that low floating stock counters will correct. Their prices can rise even further, but eventually they will correct. And hence, for an investor, it is a trade where you keep on reducing your holding in low floating stock, expensive valuation stocks, and try to buy high floating stock and reasonably valued counters.
Yeah. So, what about FMCG sector? Is that does that fall in this category? Because they are always assured of growth. They grow with the economy. They grow with the changing trends. They grow with monsoon, and they are not huge capex heavy companies. And what do you think FMCG would be? Because they move very slowly in the markets, you know.
So again, FMCG companies cannot take their business for granted. They have to keep on investing in the brand. Their brand should remain relevant for the new sets of consumers which are coming in. And most importantly, they have to invest in distribution. Murli, just to give you a small example, under Pradhan Mantri Gram Sadak Yojana, rural connectivity has gone up substantially. There were, let's say, old FMCG companies which were serving mainly urban India and semi-urban India, but not rural India because of lack of connectivity. When this Gram Sadak Yojana started building connectivity, they probably didn't move with the time. And that allowed emergence of many FMCG companies which are leveraging rural road connectivity to capture rural market. Now, this requires different skill sets of distribution, but people who are early mover in capturing rural market, they are witnessing growth. So we have seen product categories where in couple of states, this kind of companies are able to sell what established companies sell all over India because of their connectivity, because of their penetration. So my limited point is that yes, FMCG looks good. Election has put money in the pockets of consumers. Budget is spending on skills and apprenticeship allowances. And there is also likelihood of good monsoon. All these things will put money in the pockets of rural consumers, and that should satisfy, that should work well for consumer discretionary companies.
Nilesh bhai, I have one final question. You're sitting in the car for us, so I'll make this quick. What to your mind is the probability of a further drawdown? Is it purely Indian valuations, or will it need to be something global in nature? It could be a yen carry trade, it could well be a geopolitical piece, or Fed rate cuts not happening, or what have you. What is, or something else that you may have thought of? What could be the biggest known factor? I know usually it's an unknown, but what amongst the known factors could be the big factor?
So Neeraj bhai, how many people were talking about yen carry trade reversal 10 days back? It was unknown, and it came and hit, and today everyone is giving yarn on yen carry trade reversal. All I am saying is that let's bow to the might of the market. It is well beyond any individual, and we have to just focus on how do we react to the correction. Every correction provides an opportunity to participate in long-term India growth story. Choice is yours. Do you want to be a trader going up and down with daily swings, or do you want to be an investor using every correction as an opportunity to buy?
Okay, Nilesh bhai, we will leave it at that. Thank you so much for taking the time out and being with us. Really, really appreciate your time this morning. All right, and of course, Nilesh bhai, we lost him, but should have wished him a belated happy birthday as well.
Oh, yes, absolutely.
Missed out on that.
Yeah.
Okay,
and also, I think Neeraj...
do we still have him? No, we still have him.
I think
we lost him. Okay, Nilesh bhai, just before we let you go, wishing you a belated happy birthday and many more to come. Okay, I think he's gone. Never mind.
Okay, so what we are gathering from the morning in the conversations that you have had with many guests and with Nilesh is that there is a certain comfort level that is coming to the markets. The comfort are 2-3 points that are emerging. One, whatever we are seeing in the US and in Japan and in the rest of the world are what in market parlance would be called market internals. You book profit, you come out, use something as a trigger. Now, from here onwards, I'm not saying that the markets will be stable. It will be volatile, but yesterday's picture gave the impression that it would be a contagion. But today's picture is giving a slightly different perspective to the market. And after what Nilesh is saying, that look, at every fall, people will buy and we will support, which was demonstrated yesterday.
Yeah, well, and maybe that is a defining factor of this bull run versus some of the others. But interestingly, we also spoke to actually just before we get to that, one other key thing that emerged in some other conversations, including I think what Nilesh had to say as well, was that because it's so difficult to predict what will happen tomorrow or in the future, the best strategy might be to look at your portfolio and try and ensure that that is ring-fenced against valuation risks and against business loss risks. And as long as that is done, sure, you may underperform if the markets were to correct, but over the slightly medium term, that will hold you in good stead. I think that was the other key takeaway for me.
No, absolutely. In fact, that comes out in most of the conversations we have as far as investors are concerned. We are not talking about traders. Today, traders will come, they'll say there is a 1% rally, they will sell on that rally and they will try to cut their losses. But as far as investors are concerned, very clearly, these things will not affect your long-term holding. When I say long-term, not 20 years, or some people hold for 20 years, but this is very clearly, you should have solid stocks in the portfolio. And this is an opportunity to revisit the portfolio, weed out the weaker ones, and strengthen your portfolio. And maybe you would have booked some cash in the process and keep some cash on the sidelines.
I think that's the key summation. But so as we wrap up this edition of Talking Point, a differentiated version, here out as we wrap this up, Dr. Edward Yardeni of Yardeni Research, who spoke about the yen trade and how would this impact other Asian peers. He also spoke at length to us about his views on India.
Well, it's difficult, but that doesn't mean that I can't go and agree with your answer in the affirmative to your question. I think we may really have seen of the carry trade unwind happen pretty quickly. And I think to the extent that key Japanese officials are basically saying either implicitly or explicitly that maybe they're going to be careful about any further tightening, that in turn would lead to some stabilization in the yen. It certainly has seen some improvement in stock prices in Japan. And so this earthquake that we saw in Japan, it clearly spread very quickly to the rest of the world, but I think it may be calming down already. Part of the reasons for the sell-off on Friday was the weaker than expected employment report for July. However, we had a really close look at it and concluded that it might have been the weather. I know that the Bureau of Labor Statistics said that Hurricane Beryl, which hit Texas in early July, didn't have an impact, but still there was plenty of evidence that the weather was bad enough around the country that it might actually have depressed the data. And today's, as you mentioned, today's data on the non-manufacturing purchasing managers look pretty good. So all in all, I think the economy is still pretty resilient. I think we'll get over this latest recession scare. We've had this recession fear for the past 2 years. It's the no-show recession. It's the most widely anticipated recession that hasn't appeared. And there's still concerns that it might at some point, but I don't think it will.
When the whole day passes like a blur, the news just whizzes past, and you're trying to stay informed. It is our job to bring you news that truly matters. At Profit 360, we cut through the clutter. The Wall Street deals, finance and policy news that could shape your tomorrow. The newsmakers, the trendsetters, and the innovators. In 30 minutes, we've got you covered. So stay ahead, stay informed, and stay profitable with Profit 360.
Headlines you start your day with. What matters worldwide is now in the palm of your hands. Get ready to seize the day and maximize your financial potential. Stay ahead of the curve with all you need to know on NDTV Profit.
Let's be real, guys. There are many financial experts out there. Which stocks to target? What's good for long term? When to buy? When to sell? How do you stay ahead of all the financial noise to achieve your dreams?
You can accomplish all your financial dreams. Let us worry about giving you the right investing insights on the Portfolio Manager.
Bro, what are you doing?
I'm trading FNOs.
So, have you made any money?
So it's simple. If you think the market is moving upwards, just buy Nifty call option. But if you think the market could slide downwards,
Simplifying.
This is Sumi Nalwala, and over the next half an hour, we'll take you through all the action in the FNO markets. It's the calm after the storm yesterday. D Street is recovering after the big sell-off in trade yesterday. A dead cat bounce is what we have. The Nifty in the Sensex both trading with gains of about 0.7%. So we're off the day's high point as expected. Got a pretty healthy gap up in trade this morning, but have sold off just a little bit in the last 1 hour or so. Broader markets are performing in line with the benchmark index. The VIX has also cooled off nearly 11%. The sector that's leading the recovery today has got to be IT, up about 1.8%. Along with that, you've got other sectors like metals as well that are staging a little bit of a recovery. And real estate, which I forgot to mention, is up 2.5%. So all in all, it looks like par for the course. Agam, after yesterday's big fall, a little bit of sanity returning back to the street. Whether it's here to stay is anybody's guess. But for now, we shouldn't be complaining.
But I don't want to speak too soon because we've actually seen the markets come off by quite a bit.
And they've already come off since the time from early trade this morning.
Look, you know, whenever you have such a sharp move, such a sharp decline on an intraday basis, specifically when it comes to the benchmarks, you have to remember that, you know, there could always be a little bit of remaining selling left. And it's not to suggest that well, yesterday's move was quite substantial in the way things could have panned out, but there are also some technical parameters which actually play out in the markets, and to a certain extent, a lot of players who would be long the markets would potentially be trapped. Probably will use this today's day of trade to move out, considering the prices are just a tad bit favorable. And after that, of course, from there on, we continue to see determining of the markets in terms of price action. But for now, of course, markets are off day's highs. In fact, the Fin Nifty and the Bank Nifty are in fact at day's lows, even though they are in the green, and Fin Nifty has gone into the red, by the way. Well, there certainly are some things that you'll need to bear in mind before we move in. But before we talk about the futures and options space, I think it would be pertinent to address Gokuldas Exports and the kind of challenges that they are at the moment facing is in Bangladesh. Samina, do you want to take this over?
Yeah, so I think the management has indicated that if there is instability in Bangladesh, one thing that could work for Indian textile companies is that these international brands such as your H&M, your Gap, the larger retailers worldwide who import from countries like Bangladesh may even consider shifting focus and buying out of India as opposed to Bangladesh. But we've got with us the management, Mr. Ganpati, who's MD of Gokuldas Exports now, joining us to talk to us about what the Bangladesh impact could mean for his company and the sector. Hi, Mr. Ganpati, thanks a ton for joining in. First up, you want to start by telling us if you've got a presence in Bangladesh. Is there any sort of trade relationship you have in Bangladesh?
Good morning. No, certainly we do not have. We do not have any business that we do out of Bangladesh. So at the moment, all our manufacturing capacities are in India, and then we have manufacturing capacities in Kenya and Ethiopia. So currently, we don't do anything out of there.
In terms of clients that you sell to, do these clients significantly buy from Bangladesh?
Of course.
Okay.
So Bangladesh is a very large garment manufacturing, country, and almost all of the large retailers buy a lot from Bangladesh.
So would it be fair for us to assume, Mr. Ganpati, with political instability now in Bangladesh for the foreseeable future, some of these big buyers of yours, like the H&Ms and Gaps and Zaras of the world, may start increasing their purchases from India to offset what they were doing in Bangladesh, just to ensure that, of course, there's no disruption in supply in that sense?
So many brands were looking at diversification, but I think the speed at which events unfolded in Bangladesh accelerates some of the thought process of, diversifying away from overexposure to that country. So many of the brands who buy a lot from that region may, consider going forward to, diversify away. And India naturally becomes a safe port of call for many retailers to source from, given our vast supply chain base. So we have a good mill base, especially in the cotton viscose area, and a strong garmenting base as well. So, there will be a lot more retailers who will consider incremental sourcing from India. But, all of this will evolve over a period of time. Everybody is waiting and watching as to how soon the events settle down in Bangladesh. If those factories come back online quickly, then even then there may be some movement. But, it all depends on how things unfold in the next week, 10 days there.
So Ganpati, just wanted to understand what sort of a cost differential is there when it comes to sourcing products from Bangladesh as compared to sourcing the same products when it comes to manufacturing in India. Is it substantial?
There is some degree of difference between India and Bangladesh. Primarily, it is induced by the cost of labor in Bangladesh as well as a weak currency that Bangladesh has. So again, Bangladesh also has humongous capacities that they have created over a period of time.
Right.
So many brands prefer Bangladesh for a slightly lower cost, which may be of the region of 10%, 15%, whatever. Plus, European retailers prefer Bangladesh because Bangladesh goes duty-free into Europe. So that is a 12% advantage straight off the bat. So that's something which, we can't even combat. So that's the advantage which Bangladesh has, particularly going towards Europe. If as and when India has an FTA, maybe that will become a level playing field with UK and Europe. But at the moment, Bangladesh enjoys that advantage.
Right. One last question, Mr. Ganpati. So while this may be a sentimental positive in some sense for the sector, and you've seen companies like yourself trading with 11% gain on the index right now, but is there any tweaking to orders from your clients since the Bangladesh crisis came to light about 10, 12 days ago, or there's been no actual quantitative changes just yet?
it's a bit early in that sense, right? Because we normally do bookings well in advance. So, we book about 2 quarters in advance. So at the moment, nobody can directly shift things because supply chains are well entrenched and tied in. Having said that, brands are always looking for alternate options and will be, having soft discussions on, in the event there is disruption, what do we do, kind of conversations. But these are all early days.
A final question from my end as well then. So what are the key brands that Gokuldas Exports deals with, which also have a relative presence in Bangladesh as well? So we deal with all the top brands in the world, and all the brands that we deal with also source from Bangladesh. Right. Okay, Mr. Ganpati, we'll leave it at that. Thank you so much for joining us and, taking us through, the current situation and kind of potential advantages the current situation in Bangladesh may pose as far as some of the Indian outfits are concerned. Of course, given the current environment, we're going to have to continue to keep an eye on how things develop. But before now, this is how things stand. Of course, Gokuldas Exports, the price of that particular stock is up as much as 10.5% at the moment. We'll continue to give you updates there, but we shift focus to the futures and options space. And we get in Sneha Seth of Angel One and Kush Bora of kushbora.com, who's joining us on the show. Good morning to both of you. Thanks so much for joining in. Sneha, I start with you on your take on the benchmarks. The Nifty is holding strong, but that is not the case for the Bank Nifty, the Fin Nifty. How are you assessing both these key indices and how would you trade them?
Yeah, very good morning. If you look at the market and yesterday's selling, I think though Nifty is trading positive, but I think on the higher side, the gap zone around 24,300, 350, 700, that zone should be acting as a hurdle. So today again we saw Nifty heading towards 24,400, and from there we have seen some profit taking. So I believe at this point in time, looking at the India VIX even, which is around 18.5 today, so it is looking that market, any bounce back should be, used to exit your longs. And in case of any further declines, I would say that, should avoid any kind of a bottom fishing, especially looking at the India VIX. In banking index also, if you see the same thing, the gap zone should be acting as a resistance, which is placed around 51,000, 51,100 on the higher side and 50,800 on the lower side. So that is the gap zone for the banking index as well. Any correction below yesterday's low can bring in both the indices on the lower side. In case of Nifty, we can expect a correction at least towards 23,400, 500 odd zone. In case of any correction below 23,900, which is yesterday's low. And in case of banking index, any correction, because banking index is currently trading around the 89 EMA. So may be possible that any correction at least below the yesterday's low, that is around 49,700 zone, we can see a further fall at least towards 48,700, 800 odd zone. So overall IVs are not very not a very comfort zone. So any pullback should be used to exit their longs.
Right, Kush, what is your call on the index? I mean, we started off okay. There was a little bit of a nice dead cat bounce this morning, but very clearly that's getting sold into as we see it. The Nifty is well off the day's high point. Fin Nifty is in negative territory. Do you feel this is once again opening up an opportunity for traders to go short on the index?
Hi, Samina. First up, a very good morning. Well, you're right. This, what we saw is now what we can call it very clearly as a dead cat bounce, at least for the Bank Nifty that slipped into red trading, at the low point of the day. I think Nifty is one index that, you could avoid for now. The reason being that, before yesterday's fall, we've seen a lot of sector rotation that has come in. And, that's been the saving grace for Nifty. You've got one or the other sector like an IT, an auto perhaps sometimes, oil and gas, on some other days. That have sort of held, Nifty in range. So I think you could perhaps avoid Nifty for now for either a long or a short trade. But I think a clear trend is on the Bank Nifty, which is downwards. There are indications that, Bank Nifty might reverse perhaps even be the leader of the next rally, that the markets see. But just for now, I think the pressure is, unrelenting. I agree with Sneha that yesterday's lows, both on the Nifty and the Bank Nifty, are the key levels to watch for. Once those are broken, I think we can see further downside. But if I were to take a short position, I would now take it on the Bank Nifty with 49,700 being the first target. Once that is taken out, you're looking at a 49,400 kind of a level also on the downside. And the stop loss here could be 50,300, 50,400 range. So go short on Bank Nifty. That's a weaker candidate even now.
Right, go short on Bank Nifty. Sneha, two other spaces that are running too badly this morning and are probably leading the recovery is IT and metals. I think anything that was part of the global turmoil yesterday is doing okay this morning. Are you spotting any encouraging long trades here in either of those two packs?
If you look at the overall chart structure for overall IT stocks also, I think though we may see some consolidation here, but expecting an up move and buying, I would refrain from that. At present, I would stay away from longs for the time being, and would focus on the stocks which is bouncing back, and we can go ahead and short those candidates. So that would be the focus for now. I would avoid any longs at this point in time.
All right, I think we can talk about stocks then. Well, at the moment, we should probably start off with those stocks which are actually seeing an increase in open interest and see how things are faring there to see whether or not there is any short covering. So that means that the second plate will be a little bit more interesting. But we start off with those stocks which are actually seeing an increase in open interest. So if we can have that for you on your screen, and we can in fact get that and potentially see how things are faring as far as the stocks are concerned. So yes, you have Deepak Nitrite and Cummins India. Even though they're advancing in the underlying about 1.5%, we don't have too much in terms of your open interest change. On the other hand, Marico is looking at a decline around 4%. We are looking at a marginal weakness in Shree Cement, Bata India, maybe some shorts coming in. In terms of stocks which are actually seeing unwinding in open interest, we should potentially have that screen for you. So interestingly, all these names are looking at short covering, though not unexpected, because today is still a day where we've seen plenty of advances and a lot more in terms of advances as compared to declines coming through. So something like a UBL, a Dixon Technologies, a Naveen Fluorine, Maruti Suzuki, all of them advancing, but with very, very, very little short covering coming through. With that, let's take a look at stocks that are on our experts' radars. So, Kush, stocks that are looking interesting to you this morning.
So, again, despite the kind of the cautiously optimistic outlook, that we have, I think one sector that is doing well, hands down, is the chemical space. One of the stocks, that I have on my radar, you've already made a mention, which is Deepak Nitrite. Open interest action through the price action itself is actually quite encouraging in the sense that there is relative strength in this space. So 3080 is the first target, 3130 is the second target, 2950 is where you place your stop loss. The second stock also happens to be from a similar space, which is UPL. Now we had seen the impact of results on this counter. It actually fell quite a bit. But yesterday too, when the markets were under such tremendous pressure, this stock was trading in the green for the most part of the day, then eventually gave off, but it was still holding up. Today we're seeing a fair bit of recovery in this one. So 555 is the first target, 570 the second target, 530 thereabouts is where you can place the stop loss. So risk reward ratio is quite favorable. In fact, if you want to take a positional trade, you could do so with a slightly deeper stop loss as well, close to 515 levels. So all in all, I think this space will continue to do well. This is one that has seen quite a bit of relative outperformance. If you want to go long, UPL and Deepak Nitrite are the two stocks that we have on our radar.
And you've liked Deepak Nitrite quite a bit, Kush, in the last couple of weeks. So it's been something that you've recommended consistently. And this morning, of course, the counter looks good. Their earnings have also beaten street expectations. Sneha, what about you? Technically, on the charts, any trading ideas for our viewers?
So I have a two sell call. The first one would be ICICI Bank. If you look at the overall chart structure, recently in the correction, we have seen some short formation. I believe we can go ahead and short this counter with a strict stop loss of 1180 on the higher side. 1180, 1190 zone should be acting as a resistance. So that should be the stop loss. And on the lower side, 1150 would be the first target. Any correction below that, it can bring it towards 1130 odd zone. Apart from this, M&M from the auto space looks good for the selling. I think last 3 sessions we have seen decent, short addition. Now the counter is trading near the previous swing lows, which is placed around 2006-85 odd zone. So it is trading below around those zone only. But I believe looking at the overall selling pressure and the shorts addition in the future segment, we can see this counter going down towards 2547, and the upside resistance zone, which is around 2800 on the immediate basis, should be acting as a resistance. So that can be maintained as a strict stop loss.
Sneha, Kush, thank you very much for joining us this morning. A quick check on the index. The market is trading flat with a slight positive bias, well off the day's high point, pretty much at the day's low as we see it, 127 points. But let's not forget, we were trading closer to levels of 24,350 at the day's high early this morning. The breadth's also deteriorated a little bit. You've had a new listing, Akums Drugs, that's had a good response from the street, up 12% as we see it. We'll take a break. We'll come back. We'll be talking to Capri Global on the other side, get a sense of their earnings and the outlook for FY25, so stay tuned.
When the whole day passes like a blur, the news just whizzes past, and you're trying to stay informed. It is our job to bring you news that truly matters. At Profit 360, we cut through the clutter, the Lord Street deals, finance and policy news that could shape your tomorrow, the newsmakers, the trendsetters, and the innovators. In 30 minutes, we've got you covered. So stay ahead, stay informed, and stay profitable with Profit 360.
Headlines you start your day with. What matters worldwide is now in the palm of your hands. Get ready to seize the day and maximize your financial potential. Stay ahead of the curve with all you need to know on NDTV Profit.
Let's be real, guys. There are many financial experts out there. Which stocks to target? What's good for long term? When to buy? When to sell? How do you stay ahead of all the financial noise to achieve your dreams?
You can accomplish all your financial dreams. Let us worry about giving you the right investing insights.
Welcome back. We are now taking stock of Capri Global and how the quarter's gone by. And for that, we are in conversation with Rajesh Sharma, the MD of the company. Mr. Sharma, good morning. Thanks so much for taking the time out. Well, we are looking at a fairly stable top-line growth with about 27% year-on-year growth in your net interest income. Your net interest income also has risen by around 35%. So can you take us through the various factors behind the top-line growth, and also keeping in mind specifically the trends that you are witnessing in advances and deposits? Can we expect this through the course of the balance of this financial year?
Yeah, sure. Thank you. So I think this quarter we have seen a strong growth momentum in overall AUM. Our AUM have grown 11% quarter on quarter and about 50% up on year-on-year basis. And that growth has resulted in a higher net interest income and net interest. Our margin have also improved because the higher interest rate spreads have resulted in this. This quarter, we also launched the Micro Lab product where we'll be funding those customers below up to 5 lakh rupees of ticket size in a rural belt against their collateral to the small entrepreneur. So there's a new product we have launched. We have added branches. So now currently we are about operating with the 968 branches to work with. So the entire growth is happening because of the growth in the branches. The AUM have grown, and then we have seen that even our overall spread is also improving. So it is giving a good direction. Despite we launched our new technology, in-house built technology platform, which has taken a couple of months to stabilize. So we will clearly see that in the quarter starting from October onwards, we will see a full benefit coming of the technology.